Hello, this is the Hartnett Flow Show walkthrough done weekly. We have in front of us Michael Hartnett's report titled Tentatively from Zero to Hero. The report is presented two ways: video walkthrough with commentary and Hartnett's main points broken out below on your screen and footnoted for easier understanding. The quote that jumps out at us today in terms of gold froth knocked gold inflows past 4 months are greater than the inflows of the prior 14 years. And it's tough to press the basement trades when the 10-year yield has fallen below 4%. In this report, based on that statement, he's going to give the case that in the short term, gold has lost one of its support legs to it rallying. And that support leg being the macroeconomic case, the domestic case about real rates, about the effect of the debasement trade, and the reality that the Fed is cutting into a potentially a boom, not a recession, and things may be getting a little bit better. But there's a lot more to it than that. Key topics include bonds. He's all over bonds this week. Doesn't talk about them a lot, but I'm reading between the lines here. Gold bulls versus bears. He lays out the case. Macro, this is our comment. Macro is dead. Geopolitics, gold support. And debt monetization. We're going to go through debt monetization and how we're essentially at the beginning of that. And we're going to hopefully explain to you why we feel that. Debt monetization meaning the Fed is going to behaviorally sit on long-term yields while the Treasury is going to finance debt at the short end of the curve. In combination with adoption of stablecoins, that's death for the dollar. And by design, not by accident, by design. Slow death, but death. All right, so let's go. From zero to hero. That title refers to zero coupon bonds, which have done very well this year, which is a sign that gold may not do well going forward. Scores on the doors: gold 56.2%, stocks 19.7%, Bitcoin 16.9%, investor grade bonds 10.3%, high yield bonds 9.3%, government bonds 7.3%, commodities 6.6%, cash 3.5%, US dollar minus 8.8%, oil minus 13.8% year to date. Zeitgeist: 10-year Treasury yields are down 20 basis points since the beginning of the US government shutdown. So maybe it's something the Brits and French could try. Zeitgeist: 10-year Treasury yields are down 20 basis points. I think I just said that. Ooh, I'm getting old. The biggest picture: in 24 months after the Lehman bankruptcy, 313 global central bank rate cuts as the U.S. nominal GDP fell 2.5%, peak to trough during the great financial crisis. In the past 24 months, 312 global rate cuts at the same time as U.S. nominal GDP is up 11%. Little wonder the world is positioned for booms, bubbles, and debasements. So basically, in 24 months following the Lehman Brothers bankruptcy, there were 313 global central bank rate cuts, while U.S. nominal GDP fell 2.5%, peak to trough during the global financial crisis. In contrast, over the past 24 months, there have been 312 global rate cuts, while U.S. nominal GDP has risen 11%. Chart 2, you can see that right there. This alignment reflects a global environment positioned for booms, bubbles, and currency debasement. Now, admittedly, currency debasement is the narrative and the story of the day, and it's correct. It's just that it's caught fire and people are talking about it that much. I think gold's price is making people think about the coming debasement. And so they're talking about debasement when they should be talking more about gold. But Who knows? There's the chart. Tell the tape. I'm just going to interpret this for you. Actually, let's go back to this first. I do have a comment about this that hopefully will be helpful. We are debasing big already, and no one knows it yet. No one. I mean, nobody that cares knows it yet. We're debasing, and that money is going into stocks, going into the economy, going into hopefully employing people. If this does not work, the recession liquidity will be the receding liquidity as they pull money out will be a global disaster. If it does, it will be a liquidity shrinking replaced by actual growth. I personally view the stop and go rally in stocks as a trepidation that the one big beautiful bill spending will work in combination with the globally um, problems. And that makes sense. Buy gold if you do not think it works, and don't buy stocks for the same reason. And we've seen money come out of stocks and into gold for this fear. All right. All right. To tell the tape, conditions for the gold rally are deteriorating from a macro point of view. That's the point of this here. What does he say? Tell the tape. The current correction in gold follows an extended period of strong inflows. Over the past 4 months, inflows into gold have exceeded the total of the precious metals' previous 14 years. However, conditions have made it difficult to sustain debasement trades. The U.S. 10-year Treasury yield remains below 4%. The U.S. actually recorded a budget surplus in September, and the dollar has been unable to break below its April low at DX 98. Now, I don't think the surplus matters much. You know, those deficits then, those big deficits that we had this year, you know, some of those were, well, I don't want to get into it. Let's just put it this way. Budget surpluses don't matter much when your debt is at $38 trillion. You need to have a change, and that would be related to spending overall. Assuming what he's saying is correct, we are increasingly dependent. When I say we, I mean the gold market is increasingly dependent on the geopolitical situation to sustain rallies now, which means news events are going to become more important. So not data, which had triggered U.S. ETF buying that the macro discretionary funds front ran since August. Um, 2 months now, essentially, right? On bank recommendations. Remember, macro discretionary bought, bank recommendations came in, normies clapped onto the debasement trade, and they sent gold vertical. No more bank recommendations are coming out, at least right now. Macro discretionary may be getting out because of domestic macroeconomic reasons. And that means the macro reasons, the domestic policy reasons, may have run their course, at least for now. And so that puts us vulnerable if a news event comes out that's not bullish for gold. Price is right. Give me a second here. Okay, bonds have been extremely resilient despite the expanding deficit and budget bill, signaling they are being bought for domestic hedge or international stuff is worse. There's just too many shorts, is what this is saying. All right, the price is right. Since the signing of the One Big Beautiful Bill, think of that as a budget. It's the One Big Beautiful Budget now. Um, Zero coupon U.S. Treasury bonds, ZROZ, have gained 10.7% and are outperforming the S&P 500. If the September CPI registers at 3% and yields continue to decline, bond vigilantes are likely to capitulate. And that's essentially where we are now. CPI came in a little softer than expected, so we don't know. But I guess what he's saying is if inflation begins to consistently cool, it came in weak, inflation, by the way, on Friday, but it was expected to be weak. So nothing really going on there yet. But if the inflation pattern continues to cool, maybe bond vigilantes will be uh, capitulating on bonds, which means they would be capitulating on gold. Bond vigilantes are gold vigilantes, at least in our opinion. So if the bond vigilantes capitulate, gold drops. He's getting more bullish on bonds. He's seeing the flows come into zero coupon bonds as indicative of a changing tide. And if you're not familiar, zero coupon bonds, uh, they benefit more from lower real rates, which is what the market is discounting. TIPS also benefit more. Treasury inflation protectionary securities, inflation bonds, they also benefit more from decreasing real rates, as does gold. The difference is, and this is an important difference, the key difference, if you're looking at zero coupon bonds, say versus TIPS, which are inflation oriented, a 20-year zero coupon treasury gives you the strongest real rate sensitivity, but zero inflation protection, while a 20-year TIPS gives you real rate sensitivity and a direct CPI based, for what it's worth, inflation hedge. So everyone is buying zero coupon bonds now, everyone, but you get my point. And in buying zero coupon bonds, they're outperforming TIPS. And if they're outperforming TIPS, then people are telling you, whether they're right or wrong, they're seeing inflation not be a problem and they're happy to buy real rate sensitive bonds that don't have an inflationary protection. That's my take on it. Again, another reason to think that it's safe, not necessarily to be short gold. It's not safe to be short gold, but I can see some people saying, well, maybe I'll lighten up on my gold position. That would be a reason to do that. Um, so that's it. I mean, that's it. I can't make more than what it is, right? So weekly flows, 23.6 billion into cash, 17.2 billion into bonds, 14.2 billion into stocks, 8.7 billion into gold, biggest ever. zero point 0.3 billion out of crypto, first outflow in 10 weeks. Flows to know, cash annualizing 1.1 trillion inflow in 25, second biggest ever. Gold annualizing 108 billion inflow in 25, biggest ever. We've had several of these spikes, only to have it come off, and then the market has gone sideways and then gone higher again. That's what the red circles that he has, the red oval, essentially is the gold market going higher after that sideways consolidation. And that was a lot of money coming into it. Question is, will it continue? I think for it to continue, I mean, this is me talking, right? From a domestic policy, normal investor boomer concept, for them to buy more gold, obviously they'll buy more if it goes up because they do that. But for them to buy more gold, they have to be worried about a recession. And I don't think they're worried about it now. It's almost like they're moving towards a soft landing type of concept or no landing. But I'll tell you how I feel that ends in a little bit. Um, Investment grade bonds, biggest ever. Stocks, third biggest ever. Tech, third biggest ever. Energy, that's different. Notice that everything is the biggest ever these days. That's because there's too much money floating around. Okay. Uh, it's not because everything is great. There's just too much money floating around. And it happens to be going to the things that make them happy as opposed to gold. Energy, biggest inflow since 2023. That goes to my theory, which is I think oil benefits from everything I'm describing. If real rates are dropping and inflation is not a problem, then the economy is going to do well. So you buy oil. Who knows? B of A private clients, you could read that. Treasury bills and bonds, 150 billion, 24 billion into gold last week in the past 4 weeks. Private clients are buying investment grade, high yield, and emerging market bond ETFs, selling growth utilities and healthcare. So if they're buying emerging market bond ETFs, that means they're probably selling emerging market stocks. I'm not sure. But assuming that they are, that's also bearish for gold, believe it or not. BMA bull and bear indicator, nothing special there, but it backs off of overbought. Rules and tools, you can see that. That's just an explanation. All right, main discussion. 3 topics on gold, on bonds, and on emerging markets. Essentially a different way of packaging the BIG trade. Only he's starting with G, so we'll call it, let's see. No, well, you can't call it GIB. It's gold, international markets, and bonds. But anyway, let's start with gold. All right. He lays out the gold case as what the bulls say versus what the bears say. So he's long-term bullish, he's short-term worried. It's the same thing he's been saying for the last week or two. Not to diminish it, but he's saying it in a different way. He's saying short-term gold seems overbought. Long-term, it's definitely under-owned. So we've had a very nice short-term rally on top of the long-term bullishness. So bulls note, what does it say here? All right, that since the start of the decade, for every $100 invested in equities, only 4 have gone into gold. Chart 10. The Spider Gold Trust, GLD, was once the world's largest ETF back in August 2011. It's now number 10, decentralization of demand. Gold remains structurally underowned, representing just 0.5% of Bank of America's private client assets under management and 2.4% of institutional assets under management, according to the October Global Fund Manager Survey. We shared that with you a couple of days ago, or maybe last week. Okay, so just a quick interpretation of this. How many times have we heard this story? Gold is underowned, gold is underowned, gold is underowned, right? And so now if you're skeptical, you're saying, yeah, we've heard that before, and maybe it's just not going to be bought anymore. I want to say I partially agree with this and partially disagree with it, meaning short term, I don't think it's going to be bought a lot more. I could be wrong. I hope I'm wrong. But long term, the difference between now and gold in the old days is I don't think after the inflationary scare, the continuing debt problem, and the geopolitical problems, that on the way down, they're going to puke it like they used to. They used to trade gold like it was a penny stock. Oh, inflation's dropping, sell gold, buy more stocks. I think they're just going to buy more stocks. Now, I mean, there could be a washout if we have a recessionary crisis that sells stocks and gold, and you just want to buy gold then. But I think there's going to be a lot less puking than in the past by normies. It's not to say macro discretionary is not going to sell, but I'm not necessarily bullish on inflows coming in. I have an opinion. It's not a strong one. All right, so let's move to the bear. So you can see that there, right? I mean, I hate that they use stick lines for these. I wish you'd be, I guess that's their style. All right, what do the bears say? Bears counter that golden flows over the past 4 months, totaling 50 billion, exceed the cumulative inflows of the previous 14 years. Uh, the same fund manager survey identified long gold as the most crowded trade. Now, despite this, the positioning remains long gold as a hedge against U.S. economic expansion, which is what I'm saying, right? The AI-driven asset bubble, again, uh, the dollar debasement, which we know, and additional asset price inflation supported by the Fed cuts, the Trump put, which is Treasury debasement, and the emerging uh, Generation Z put. I don't know what that is. All right, so I think it's a call. I think they're going to sell it. All right. Ooh. The bear argument is pretty simple. The bear argument is that uh, at some point the mean gets regressed to, and you got to be honest. I mean, $50 billion is more than the cumulative inflows in the previous 14 years. That's crazy, right? Um, and if you're wondering about the fund manager survey comment, the last time they were calling gold overbought or crowded, it went sideways for a month or two, and then it broke out higher. I think it was in July, maybe June. They said gold was overbought, and gold did have a dip, but that knife was caught. And after that knife was caught, it went sideways for 4 months, and shorts got decimated. Um, so the Global Fund Manager Survey is a pretty good contrarian indicator in gold. Um, so if you're going just by that, you're not bearish on gold. It would seem that see how he says we stay long gold? All right, so basically he's going like this. The bulls say this, the bears say that, and this is what Bank of America says. We say you stay long gold to hedge the US boom, the AI bubble, and US debasement risk, and more asset price inflation on the Fed put. Yes, look, Hartnett is saying, he's not saying add to gold. And I think I said that last week. He's not adding to gold, he's adding to oil. He's saying hold gold. It's a barbell trade. It's a hedge for your equities. As long as you're long equities on the tech side, especially, you're long gold. Because gold is a hedge for the asset price inflation bubble. The Trump put, which is fiscal spending, and actually it's the best end put. I'll describe that a little bit. And the Gen Z put, I don't know, I'm not sure what the hell that means yet. Uh, let's see. Uh, I guess he's saying Generation Z is going to put money into this. I don't see it, but okay. He knows better than me, right? Uh, so let me think about this. Okay, all right. Just trying to tie this together for you all. The bounce that we got off the lows, the $100 bounce off the lows, very impressive. I mean, extremely impressive. But the lack of follow through thus far warns that if a date warns that we have a date with the 20-day moving average. Now, I don't have a chart in front of me, but uh, our hope is, absent a spike higher, our hope is sideways consolidation at this level. Not 4 months of it, but sideways consolidation at this level. Our fear is that with these macroeconomic drivers possibly waning, our fear is that Trump and Xi actually do have uh, a productive meeting. I don't think they will, and that's why everyone is long gold. I think it'll be a can kick down the road again, and all the reasons for owning gold remain in place, macro discretionary, and all the reasons to own gold geopolitically remain in place, and we're off to the races again in a month or two. But it feels like the boom trade, the economic boom trade, is now headed to the forefront, and oil is being bought to replace gold. Now there are OPEC reasons to buy oil, but I think that some gold people are putting money into oil. And if I'm right, we should see Bitcoin rally as well, but we're not, so I don't feel like I'm right yet. All right. Bonds. Hartnett feels bonds are still under owned. This is what he's been saying for a while, but he's giving you different reasons. He's actually giving you proof that things might be changing. And again, that concerns me about gold. Hartnett feels bonds are still under owned, and given that he hasn't been wrong yet, really, he hasn't uh, on bonds, but he hasn't been really right. It hasn't really done much of anything. His time, it seems he feels, is coming to be right in a big way. So let's go through what he says here. Bulls point out that according to the Bank of America October Global Fund Manager Survey, institutions are holding their largest underweight in bonds since October 22. That was before a rally. The same survey shows the highest share of investors expecting higher bond yields since June of 22. They actually were right. Uh, all right. Among private clients, allocations stand at 70 billion in treasury bills and 70 billion in treasury bonds, compared with 700 billion invested in the magnificent seven equities. That's just a reference point. So that's the bulls. The bulls are basically saying there's not enough money in bonds, period. Right? Bears argue that these positioning extremes are irrelevant, expecting corporate bond yields to trade below government yields within the next 12 months. Okay, that right here, if I was Hartnett, I'd be very happy to hear that because that means to say I don't care and that corporate bond yields are going to be better than treasuries is just irrational. It may be true, but it's irrational and it smacks of FOMO. So, what does Bank of America say? They feel that after a severe 5-year bear market, which the value of global negatively yielding bonds, oh, here we go, peaked at 18 trillion in December 2020. He's describing that as the last bubble. We disagree, but we'll come to that in a second. Yields are now entering a cyclical decline. The projection is for the U.S. 5-year. Okay, so basically saying the worst is over in terms of negative yielding bonds. The projection is for the U.S. 5-year Treasury yield to move below 3%. Yeah, he's getting really bullish on bonds. And the 30-year yield below 4%, driven by upcoming Federal Reserve rate cuts, labor market weakness linked to AI adoption, and increased government intervention in sectors such as energy, pharmaceuticals, housing, and utilities to manage consumer price inflation. Okay, let me think about this a little more. Political considerations also play a role because why? Because midterm elections. Yeah. Midterm elections will require improvement in President Trump's 36% approval rating on inflation. Okay, so this is a story he's talked about before, uh, and he's updating it, and it's valid. All right, so let me just start with this here. All right, so this here, the market has worked off. It's a sign that the market has worked off um, massive $18 trillion negative interest rate bond debt bubble and survived it. We've been in a bond bear market since 22. Um, and his point is that you've got one big monkey off the bond market's back. I can't say I disagree with him. Where I would throw caution at that is there is another bubble. And the other bubble is the Fed balance sheet. See, the Fed balance sheet may not have negative yielding bonds. And the negative yielding bonds, which were out there in Europe and Japan, may have offloaded for the most part. But the Fed hasn't sold any mortgages from the great financial crisis. I believe, let's put it this way, assume they haven't sold any meaningful mortgages since then. And that should have been done through QT, and we haven't done it, and we're stopping. So here we are, 17 years after the great financial crisis, and the government's bond portfolio is not running off. Now, I'm going to combine that with a concept that Michael Howell talks about a little bit later on and explain why, in combination with the Fed's balance sheet not running off, QT stopping, and rates dropping, and best sense, Treasury now funding most of our debt at the short end, you will see a considerably weaker dollar. We'll get into that in a second. But let me just stay on that. Oh, there it is. Right back. Just some more notes that I have here that I should read. Um, We note that the current bubble is the Fed balance sheet. I mentioned that. This is exactly how the 70s went to, by the way. That inflation was under control and we should all party in 1976. Well, followed after that was a disaster. So short-term bullish bonds. Intermediate term, no opinion. Long term, very skeptical. This spending that we are doing doesn't kill bonds along with the rest of the world's real rates if they go negative. If bonds survive, and I'm wrong about that, the dollar will not, due to yield curve control debasement plays, which we're going to talk about again in a second in a different light. I mean, they stopped QT. I mean, they stopped QT as they're cutting rates. All right, never mind. By the way, these are all, some of my comments are all footnoted here. So I roll over that. You see that? Not all the comments, but some of them. On emerging markets, I'm just going to blow through the emerging markets one. Emerging markets, the October monthly close is seen as critical, with emerging market equities attempting a breakout to new all-time highs. Chart 7. This move has been driven by expectations of a U.S.-China trade agreement. There you go. That's what's going on, right? Which, if completed, would confirm a global risk asset and equity bull phase. Yeah. Consensus anticipates a deal announcement next week, viewed as equally beneficial for China and the United States due to China's successful export reorientation away from the U.S. Yeah, that's actually true. Here, take a look at that. Um, and its leverage in rare earth exports. Shipments of rare earths to the U.S. are down 26% year to date, reaching their lowest levels since 2020. So there's charts 5 and 6. Okay, so just to walk you, spell this out. Whether the markets are right or wrong, we don't know. But the markets are discounting based on this chart. The markets are leaning towards there being a good deal coming out of the Trump Xi meeting. And as a result of that, they're long stocks and they're also long gold. I think they're longer stocks they should be and not long enough gold. However, if peace comes out of it, what are they going to do? They're going to, the funds are going to sell their gold, which is a hedge for their stocks, and buy Chinese stocks. That's what's going to, and US stocks. That's what's going to happen. Now, these two charts are the evidence that doesn't say that will happen, but they are the evidence that the terms will be dictated by China, not us. The first one on the left, they're cutting off our rare earths. I cannot emphasize, without showing you data, how important rare earths are for us. Our economy is propped up by two things: consumption, consumers buying stuff, and military spending or military sales, submarines. Like the rest of the world is building up its military. They're buying that from us. And rare earths, you cannot make a nuclear submarine without rare earths. I'm not even getting into the public aspect of rare earths for EVs. Forget EVs, even though they're not going away, but they're not lighting up the world right now. China cuts off rare earths to us. We have essentially about, depending on who you talk to, 6 months supply. So our economy shuts down in 6 months. There's no mines for rare earths that we've opened up yet. All these deals we're talking about, I'm not saying it's smoke and mirrors, but I am saying it's a celebration before graduation. Let's put it that way. So what I'm saying is, do you think in 6 months the Chinese economy would collapse or we would collapse? Well, you move to the right and you see that China has definitely replaced um, exports in dollars with the US. I mean, replace the US by other countries. Now, the obvious thing there is the dark blue line continues to go up and the light blue line continues to go down, goes down now. Okay. I want to draw your attention to a nuance that makes it better for China than most people would even talk about. See this portion here? that was the trend. We were everything they sold to 12 countries. We're not talking about rare earths, we're talking about trade in general, right? And then in 22, when the war started, they sold less to us and the rest of the world, or the total world in general. I'm sorry. They sold less in general and a ton less to us. So you can see the big yawning gap there. And that yawning gap is consistent with them losing sales total, well, them losing sales to everyone else and losing sales to us at the same time. Now look at this slope going back up. This is the US coming back online with the rest of the world. And look at this, it's still going up and we're diving. So the question is, if you believe this data, some analysts are saying dollar bulls will say this: China can't sell its goods to the rest of the world at the prices it can sell them to the US. Meaning, you'll get your Costco umbrellas, but they won't be at the same price that we pay for them. They'll be cheaper. Well, this chart, assuming it's true, says otherwise. I mean, take a look at that. I don't know that it's true. Maybe some of the data is cooked on the Chinese side. I mean, we cook data, and they cook data for sure. But it's disturbing, right? This data, you put these charts in front of Trump during a Trump Xi conversation, and assuming that they both know they're accurate, they'll just be like, we want a higher gold price. I mean, that's the look, this trade deal or whatever happens, let's assume that the best thing happens. The best thing that happens is going to happen in China's favor. And that will be bullish for gold. It will. It's going to be a term that you don't hear about if it goes really well for China. It's going to be, we need the dollar to weaken. And the dollar is going to weaken against gold. And we personally, we want the dollar to weaken. We just don't want it to weaken against China. We want the Chinese currency to weaken as well. But that ain't going to happen because the Chinese currency is rebasing off the dollar onto gold, my opinion. So these are the two charts that show you that the US is not in a position of strength. Now, if you listen to Trump speak last couple of days, we're going to have a great deal. Like he does that all the time, and sometimes he's right, sometimes he's wrong. I just I don't hazard a guess anymore. I do know that he likes to spin going in, and he likes to spin going in because against a weaker opponent, it would make them blink, kind of like a boxer like Ali talking tough to Frazier and how it made Frazier upset back in the day. It certainly worked with Canada, right? At least I think it worked. But it doesn't work with China, and it worked with China in 2018. It didn't work with China this time. So I really think, based on the behavior of China, and I think that gold's price rally was in part Chinese buying near the end there, and the U.S. had to step in and put a lid on it. I firmly believe that. That's not tinfoil hat stuff. Anyway, look. I don't see how this deal comes out good for us, even if Trump declares victory. Both sides are going to declare victory. And even if it is good for us, meaning good for us as a country in the longer run, it won't be good for us as consumers. Like I can almost guarantee that to you. Debasement comes after this, the real debasement. But what do I know? Asset class flows, table one. You can see that. Fixed income flows. Here we go. Inflows resume. All right, I'm going to talk about uh, this debasement thing or monetization. That's really what I want to talk about is monetization. Equity inflows. Here we go. I like by style. By style inflows, US large cap, US small cap outflows in value and growth. I don't know how to take that. By sector, inflows into tech, materials. Okay, right. There's your barbell trade. Tech and inflation. Energy's creeping up now. Utilities, that's going to probably drop. Look, Trump is doing what Ford and Nixon did. He's using price controls. He's just not calling it that. He went to Big Pharma and he said, you're going to lower your prices. And they had to, right? Right? He's going to go to utilities and say, you're charging too much for energy. And he's basically going industry by industry, implementing price controls at the producer level, not at the supermarket level, so to speak. Okay. Um, Communication services, yeah, that would be next. That would be next. All right, so that's it. There's your price controls. Hartnett talks about that indirectly. I wanted to bring that up. That's the political aspect of it. So, for example, we go into the midterms and Trump gets utilities to cut their rates 20%. That's a win for the consumer, right? It's a win for the price control concept, which keeps inflation down, and it's a win for popularity. Very popular way to do that. I mean, I haven't seen it yet, but maybe we'll have some of that. All right, so institutional flows. Institutions are buying gold and silver and commodities. They're buying more commodities than gold and silver now, which means they're going into the boom aspect of it. And over here, there's still private clients are buying precious. Still, look, private clients. Oh, it's too small. Private clients may be buying precious. Here, there, they're right here. If you can't see it, right in there. But they're never going to buy more than the speculative stuff, right? On the other hand, institutions are buying more aggressive commodities now. They're not, well, they're still buying gold and silver hand over fist, but so there's the quilt, and there's the footnotes. So let me get my notes here together, and I want to talk about the monetization concept for a second. Okay, so debt monetization. I don't have a chart prepared, but I think this is important enough to talk about now. If you're not familiar, or if you are familiar, it's worth hearing this again, possibly. Debt monetization is simply at the simplest level. It's when you say, I'm not going to unwind my debt, I'm just going to let it roll to cash. So you have a 30-year bond and you never retire the debt. And so it rolls to cash, which means the full weight of that bond will be felt in the dollar. So if you can picture, maybe I can do this. You can picture a 30-year bond, right? 30 years out here, right? The 30-year bond goes to zero. What happens is the bond never gets puked and or never rallies. It just goes out at its face value. And that means over that time frame, all that money is created. And that's monetization of debt. The last big monetization of debt we did was after Vietnam, which was a big factor in the 70s inflation. That was financing Vietnam, uh, which after not being after still having yet to complete financing of the Korean War. So we monetized that debt, meaning we never retired it, we never bought it back, we kept rolling it over and over and over and over. And the other thing was uh, the great the increase in the welfare state. They had a phrase for it back then. I forget what it was. The great something, like the great deal or the new welfare state. I'm not sure what it was called, but that was because you had a lot of people coming home from troops, and we ramped up our welfare state because you had a high level of poverty and stagflation, and then oil embargo and what have you, and on and on and on. And so what happened is we didn't sell our bonds. We stopped selling bonds because we couldn't afford to finance our debt anymore, and we stopped buying our bonds back. And so the dollar got weaker. So when you have a situation, let me draw a couple good lines for you here. There's your yield curve. There's your graph. Here's your yield curve. Generally speaking, I'm simplifying, but let's say that's the 30-year bond yield. Call it 5%. And let's say this is the 30, let's drop this lower. And that's Fed funds. Okay. Fed funds is, call it 2%. It's not, it's higher than that now, but let's say it's at 2%. So the government does most of its financing out here. Long-term debt. Why? Because it's stable. It shows that we have a long-term commitment to our economy. And it shows that we're not, just cheating. And this, by the way, this part of the yield curve is allegedly completely free market. This part of the yield curve, which goes from here, give or take to here, is dominated by this. The Fed literally manipulates yields in the short end of the curve. That's why they say short end versus long end. So if interest rates are 2% here, then you're going to have a smoothness of the curve that's going to be dominated, contingent upon 2-year, 5-year, maybe all the way out to 10-year. 10 years probably where it breaks. And then 10-year you have a transition where the 10-year becomes more like the 30-year. So that you have almost what you have is a stitching of two curves together. Now, if you're still with me and you're not bored by this, I'm going to explain yield curve control visually now. Yield curve control, which is used to keep inflation or the fear of inflation down, says we're going to take this yield at the 30-year and we're going to drop it to here and then here and then here and then here. I'm exaggerating, but I'm actually not exaggerating. Japan did this. So you get your yields to go down there, but I just said we don't affect the long-term yields. That's right. We don't set the rate on long-term yields, but we buy the bonds if we want to. And in buying the bonds in the quote free market, you buy the bonds. That's what QE is. QE is buying the bonds. QE is buying as many bonds as you have to. You're buying a quantity of bonds, right? Quantitative easing. Yield curve control is qualitative easing, meaning you say to the world, we're not going to buy bonds until it gets to this rate. And if it gets to this rate, it will not go higher. You shall not pass. And then after the market believes you, then you say, we're going to buy bonds all the way to here. You shall not pass. And so the yields start to run. If you do your job right and the market fears you, you manipulate the yield curve down, 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 down. So what you're doing is you're taking on all sellers, taking on all sellers, and you keep doing it. And the reason they keep doing it during QE is because, or not during QE, but it's a form of QE, is because they want the yields to get to a certain price. Because at that point, people will put their money in stocks. Shit, I'm only getting 1% in bonds. I may as well put it in stocks. Now, that's essentially, that's the mechanism of QE. So you're supporting long-term bonds, you're reducing long-term bond yields. Yield curve control is the same thing as QE, except as I just said, you don't buy a volume of bonds, you buy yield of bonds. I'm buying them 5%. So QE is basically say, I'm going to buy all the bonds you sell me until I say I'm going to stop, right? Um, Yield curve control is a combination of I'm going to buy them at 5%, I'm going to buy them at 4%. You're using the yield, but simultaneously, the bonds you're buying here, okay, you're also selling bonds here. Now, why are you selling bonds here? You're selling bonds here because this part of the yield curve is dominated, controlled by Fed funds. So you're going to buy bonds in the part of the yield curve that's historically unmanipulated, thereby manipulating the yields. And you're going to sell bonds into a market where the yield is fixed by you, heavily manipulated. So what are you doing? You're doing yield curve control. So this is the yield curve. After yield curve control is over, even though it shouldn't, well, even though it should because of your operations, bond yields drop at the 30-year. But even though it shouldn't, because we're taking the same amount of debt, call it $1 trillion, that we were lending here, that we're borrowing here, and now we're borrowing it here. So even though we're selling debt, the yield comes down here anyway. Because why? Because we keep the short-term rate artificially low. So instead of looking at this like a yield curve, I want you to look at this like a balloon. This curve is the inflated balloon. This curve is the deflated balloon. This space in here is the extent that inflation is being manipulated lower. And what happens to all this space? It comes out the hole in the balloon, the front of the balloon, the nozzle. And you know what this is? This is the dollar. And so what you do is you take the debt and you make it money. You monetize the debt. You give the inflation no place to go but out the front end of the curve. And you lie about the rates at the front end of the curve because you're trying to keep the back end of the curve at least make a little sense to the front end of the curve. And so you manipulate the whole fucking yield curve. And having a yield curve that's completely manipulated, Fed funds, 2 year, 5 year, 10 year, 30 year, what have you done? You tell an investor, you better put your money in stocks because the dollar is going to zero. And if they don't, you know what a foreign investor says? Screw that. I'm taking my money out of dollars altogether. And the exodus out of dollars continues. It gets bigger and bigger and bigger, and the dollar drops. Now, the reason the dollar won't drop against the G7 as much is because they're going to do it too. They've been doing it. The reason it will drop against emerging markets is because they bought gold. And this is why you need to continue owning gold. This is, by the way, all this stuff that Hartnett's talking about, the geopolitics, the hedge against inflation. When that stuff manifests, this little scattergram that I just drew for you is how the Fed handles it. They manipulate long-term yields lower, they hold short-term yields lower, and they squeeze all the debt out the front end of the balloon in the form of dollars. And that, my friends, is yield curve control and how it's used to monetize debt. And that's what financial repression is. Hope that helps. But that's where we're headed. Now, what prevents us not getting there, right? What prevents this? So this is where, here's the scenario that I'm painting, right? This is where we are now, right? And as soon as Powell sees it necessary, he's going to do this. I'm exaggerating, but maybe not by much. So this rate will be too low because we'll lower rates when we don't have to. And this rate will be too low because we will go from letting the market be free to manipulating the long-term yields. What makes this work? What makes this work is the US becomes productive. So if we start making stuff, which we're not yet, and after making that stuff, we start selling it to other countries, which won't be as easy as it used to be. And if in doing that, people are working, which won't happen because of AI, then you have me saying to you, there's no way this works in 5 years, maybe in 20 years, but we have to add UBI to the mix because if we're going to be productive enough to get out of this problem, to make this stuff that he's doing work, to buy us time, that's all this is doing. It's buying us time. If this is to work, then AI is going to be in a big way replacing the workforce at the white collar level. And if that happens, you need UBI. You can't lower two legs of a stool and have the stool not fall over. There are three legs on the economic stool. GDP, which is the economic productivity, inflation, which is inflation, and unemployment. Those are the three legs that hold the economy up or lower the economy. If you raise inflation, as a base from 2 to 4%, and you raise unemployment by 3 to 5%, you need to raise productivity higher. And if you don't do that, the stool falls over when you sit on it. And there's the analogy. Have a great day.